When you look at the housing market, because everyone in single family is locked in their mortgages, right, at under 4%, they're not moving, which means there's no supply. There's no supply to buy a house. So what do those people do? They go rent, right? And that's why build-to-rent communities are growing really fast. It really is the solution for a lot of these housing problems. Hey, you can have something like a house, but rent it. It's how apartments, I think can continue to absorb until supply becomes too much. But multifamily, for all the demographic reasons, has performed really well. People will still need a place to live, and so I think multifamily continues to stay full.
On today's episode, we have Executive Vice President of OMNE Partners, Alex Epstein. Steve, Alex came prepared for this podcast episode. He came with all the information. He gave us a deep dive on what's going on in real estate in Omaha, but he went even further. He went, countrywide. And this is, if anybody's wondering, hey, what's going on in real estate today? This is the episode for you.
Jake, it's when I was listening to Alex and hearing his story from graduating from Indiana and his Twitter company and Target, and then how he got into real estate, it was refreshing to hear him as in the trenches, what's actually happening in real estate, and specifically in Omaha that can be applied to many parts of the country. But I learned a lot, and it was a great interview. He was there.
Yeah, you could tell. You alluded to it. He started a company when he was in college that was taking advantage of the Twitter trends going on, and you could tell in this interview that he is a guy who knows his details. He knows his facts. He knows his data. It helped him back then. It's helping him certainly now in the real estate market. So this is an episode people are going to really enjoy if they want to know what's going on in real estate, but it's also some really good stories about how his Twitter company competed with Barstool Sports, how he ruptures Achilles playing pickleball. I mean, it's across the board, but it's really entertaining. So let's just head west. Yeah.
He's just doing life, which is awesome.
Let's head west so people can jump in. Stay tuned as we discuss competing with Barstool Sports, converting office spaces, and the best asset class in 2024 with our guest, Alex Epstein. This episode is brought to you by Skyline Point Capital. If you're anything like me, you're always considering where to invest your money. Stocks, bonds, crypto, and rental home, the list is literally endless. As we've all seen over the past year, the stock market is unstable, the housing market is just weird, and inflation is on the rise. In times like these, the clear place to invest my money is in multifamily real estate, aka apartment complexes. Here's why. Returns on real estate investments have little to no correlation with the stock market. There's lower volatility, stable income streams, and the tax benefits are insane. And let's not forget that the apartments will typically appreciate in value over time, which means you can walk away with a pretty nice return when the complex is sold in 3 to 5 years. Best of all, multifamily investing is passive, so you get all of the benefits without the hassle and headache of your typical rental home investment. Getting started has never been easier. Head to skylinepointcapital.com to learn how you can start investing today. All right, well, Alex, I thought we'd start our conversation with a story that you shared with us. Yeah. And I'm just going to read it verbatim, and then you can tell us how in the world this happened. But you had said that at one point in college, you had 700,000 Twitter followers under an anonymous college humor handle, which is super impressive to begin with. But then you were able to parlay that into a business that did 1 million unique visitors a month to a website. Unpack this, explain what the heck is going on, and what exactly you were doing here.
Yeah, so that was my pre-commercial real estate life, and arguably much more entertaining, depending on who you ask. But yeah, that's kind of, a story that, doesn't seem seems like it's a couple centuries ago, but if you think about a world where there's just Twitter, there's no Snapchat, no Instagram at the time, so circa 2011, maybe Instagram was just starting. So thought it'd be funny to share, my insights on Twitter under an anonymous handle, but it not be tied to me because, of course, I was interviewing for jobs after college. Sure. So I didn't want my name a part of it, and just started kind of as a joke. And then I show up to, one of my business classes, and then everyone, I look to the person right of me. They're looking at the Twitter account, laughing. They don't know it's me. I said, "Do you think that's funny?" And they go, "Oh my God, you got to follow this account." I go, "Really? I'll have to look into it." And, so shortly, by the time, within a few months of starting it, it's 10,000 followers, 20,000 followers. Then I went on a spring break trip and realized, met some people from University of Iowa. I went to Indiana University, and, they started talking about the Twitter account too. So I was kind of shocked.
Gosh. Yeah.
It spread outside of Indiana, and didn't have a business plan for it. Didn't know what I was doing with it, but it just kept growing. And so, yeah, at its peak, 700,000 plus followers. And, the big thing then was trying to monetize it. So at the time, my competitors, if you will, were Barstool Sports. I'm sure some people have heard of that.
Yeah, maybe a few.
A couple of times.
A website called The Chive, and then Total Frat Move. And, what the Chive was probably the biggest at the time. Barstool was, monetizing through advertisements. And, really there's no such thing as an influencer in 2011. Kim Kardashian was one, no one else was. And, so it's a big joke of, well, you got a lot of followers, but you're not making money. So
yeah,
the quick solution was to, my background, just high school, college was in somewhat journalism and student newspaper. And this kind of voice, why I think the Twitter account went so viral, is it was really a voice for college students that they could resonate with. And it wasn't being, everything else at the time was just, very edited. You had The Onion, which is more of a political college website. You had the student newspaper, which was very appropriate, but you didn't just have kind of a website where people could write what they want, say what they want, and then hit publish. And so created a website where all the followers could just submit articles. I'd publish them, and then it'd drive people to the website. And then there's Google ad revenue. And so, the short, I guess the short story on that is became wildly popular. Everything from, any type of drinking game associated with any type of athletic event, music event. I think the most viral one was Victoria's Secret fashion show. We published a drinking game associated with that. And then, it just, was going just, I think it was trending on Twitter for a good bit. And then that resulted in about 1 million unique visitors a month, which was healthy ad revenue.
Yeah.
And then kind of the demise of it was, when you're not filtering the content, you have a lot of inappropriate, content that Google Ads didn't like. And so then, then Google Ads stopped serving the website. So then there was no way to really monetize it at the time. And, that's when I started looking into, hey, I need a career. This isn't going anywhere. Hindsight, I don't know if I made the right decision, because I think Barstool did 17 million unique visitors a month and was valued at 583 million. So, and that's 10 years later. So you kind of, it's the big shoulda, woulda, coulda, was almost there, but didn't do it. So,
quit too soon.
Yeah.
Did you end up just shutting it down, or did you sell it, or what happened with it?
So basically, at the time, there's also a big issue, from a content perspective. You had as time progressed, kind of 18 months, a year down the road, you notice all your followers who were then college students are now grad students. So big, or graduated young professionals. So the question becomes, do you stick with a college brand, or do you migrate your content with your current subscribers? So that became, an identity crisis for the brand of, do we start publishing postgraduate content, more into what's going on in your quarter life crisis, or do you stick with, very immature college student content? And then, the following was really migrating to Instagram, where we didn't have a following. And then without ad revenue, it was a quick fall, and I really was burnt out from it, wanted to go start a career like my peers were doing. And, I ended up selling it to a startup company that had a product they're looking to launch through the platform. Nothing ever came of it with them. And it was just kind of a simple exit, nothing too exciting, was able to learn a lot, wipe my hands clean of it. So it's good to, just get a token and be done, but it certainly wasn't, possibly as exciting as maybe hindsight looking at the potential it could have had to grow into something different. I think one of the big mistakes, I made is a lot of competitors pivoted, said, well, if we can't serve ads on here, we'll sell our own product, right? So they became an apparel company, which you see, that's what Barstool, really, one of their main things is they sell apparel, total frat move. They became an apparel company, and they were distributing their apparel through Dillard's and Von Maur and Nordstrom. Could have used the platform to create a product at the time and pivoted and grew something. But ultimately, for me, I guess my calling was in brokerage.
Hey, Alex, you're telling this story, and we probably have some listeners going, what was the name of that site? Because
Yes.
when I was in college, I was doing this. Is it the same one? What was the name of the site?
Are you allowed to say?
Yes.
Can you say?
Yeah, no, I mean, it's nothing today. It's called the College Town Life. And on Twitter, it was at College Town Life. And, after every kind of tweet, we do hashtag CTL, and that's what, which stands for College Town Life. And that's what people use to submit content to get retweeted. And, at its peak, again, there was a website called Clout that measured your influence versus mentions, retweets, ultimately the kind of social power you had over Twitter. We were a top 100 Twitter account at the time, ranked above Target, Axe Deodorant, Taco Bell, some pretty significant brands.
Wow.
That's just because when we would, tweet out something, it went pretty viral, a lot of mentions, a lot of retweets, and a lot of that. But again, in an era in which an influencer, that meant nothing. How you got ad revenue being big on social media meant nothing. That it just didn't really exist. And so that's kind of the story.
Alex, it seems like just from when you're talking that your mind is always thinking, what's the next thing? What can I do? And when the College Town Life, you're graduating, you got to get better grades. It's time to get on the horse and in the real world. What were you thinking?
Yeah, I mean, I really at the time didn't think that would, just for timeline, when I graduated, I had about 25,000 followers. I accepted a job in Nashville, Tennessee, moved down there. And then by the time I moved down there, I had 100,000 followers. And I was spending all my time on it and really focused on growing it. And ultimately ended up just moved to Nashville, grew the website. And, I think at the end of the day, it was growing exponentially every month. So, you go from 20,000 followers to 40 to 80, unique visitors go from 100,000, 200,000, 200, 400. So the sky is really the limit. I mean, I thought I'd be, forever sitting by a pool, just tweeting. And, and so that's kind of where my mind was at. But I realized pretty quick, the grass is always, green, the grass is always greener. And maybe that was for me, possibly not having the patience to stick with it. I was jealous of everyone, working the entry level job at 3M, Target, Ernst and Young, wherever it might be.
Yeah.
And, they had stability. I was in startup mode, and, you can get burnt out from that pretty fast.
You probably felt like you were missing out too, especially as you graduate college and you say everybody's going to Target, 3M. What am I missing here? Like I'm trying to build something, like I'm continuing what I did in college. They've exited college and have moved on to another chapter of life. That's probably some feeling of got left behind, missing out on something.
Yeah, definitely. There's the thing of growing up, and then, it wasn't formalized. I had, a business partner that helped with web development and the technical side of it. And so he was in Minneapolis, I was in Nashville. And so, you didn't show up to work and have a culture. You didn't have coworkers or peers, which was unique then was, I was communicating with college students and writers remotely and managing campus reps and doing that sort of thing. But definitely, to your point, you'd see people at a company happy hour and you'd go, oh, that looks really fun. Not realizing, that, I do think hindsight, I much prefer entrepreneurial startup culture than corporate America. So.
Sure. Yeah. So then, okay, so you sell the business and you decide, okay, I need to get into the real world. How do you end up in real estate? Was it a direct pivot or did you have something in between? Tell us about that.
So that's actually some of my friends' favorite story is I went, I was really envious of the people that got jobs at Target headquarters. It was a powerful brand, seemed like a great career track. And in my mind, the way I was raised, I was like, well, I want to go get a job there. Coming out of the Kelley School of Business at Indiana, I don't even think I got an interview with them. They were interviewing all the top students. Believe it or not, I wasn't a 4.0 student. I know Steve wouldn't believe that. And so then I sent Target a cover letter and kind of said, hey, my brand I created is ranked above your brand. I want a job. And
it's either going to piss someone off or they're going to be really interested.
I love it.
Yeah. And so I went through the interview process. I think I had a story that was different than other college grads. And so they hired me and I was going to become, a business analyst for them and a buyer. And in my mind, I said, okay, well, be a buyer for a year, senior buyer for a year, and then maybe I'll be CEO of Target. So I didn't understand how corporate America quite worked.
Sure.
And within, it's pretty funny. So right away, they randomly place you in a department. And so, if you really want to be in maybe the music department, that's pretty cool, or sports apparel. Well, they put me in nursing bras and panties in department D22 and D23. And
that's great.
And, I grew up with two brothers and, I had no expertise in nursing bras and panties, knew nothing about it. But I really quickly wanted to leave my mark on that department. So I convinced them, we're sitting through the first meeting and they said, well, we've got our heather gray, nude, black, and white or off-white. And these are the nursing bras. And this is how many units we're going to order. And I raised my hand and I, using the Target lingo, I go, don't you think the Target mom might want to feel, a little more alive, a little more sexy? Why don't you give her some animal prints, some polka dots? Like, why are we just doing solids here?
Yeah.
This was my, multi-million-dollar bet
Yeah.
at Target
Yeah.
to raise up the ranks. And then so they were like, well, that's interesting. We've never heard that before. All right, we'll run a test run. And a few months later, product comes in, hits the test stores. My manager grabs me, says, hey, let's go to the headquarters store. Let's go look at it. Alex, come over here. And I look, I go, oh my God, there it is. It's all here. It's great. She goes, well, it's not really good. It's all here. It means it's not selling. So it says on the clearance racks pretty fast. And that's when I realized, you know what? I don't think I'm going to have a career in nursing bras and panties at Target. I want to get into something more fruitful. And so growing up, I knew a lot of developers in commercial real estate and was able to connect with some of those people that had done a lot in Omaha. And they basically helped guide me to, hey, this is what a career in commercial real estate looks like. And that's how I made a decision to start in brokerage.
Yeah. Was your family investing in real estate, and that's how you knew these brokers, or was there some other connection there?
No, my family's background, they were in wine and liquor distribution and, distributed that throughout the state of Nebraska. And for me, they a lot of their friends and peers in Omaha were in commercial real estate. So I was able to reach out to them, and it was just something that really interested me from a perspective of, if you're going to go sell anything, right? Being a young professional, you kind of have a choice. You can sell, printers, you can sell office paper, you can sell cars. But, there's really nothing more, prominent and sexy as selling commercial real estate. It's probably the most expensive asset other than maybe commodity trading that you can go sell. And it's physical and it's there. And so that really interested me to be part of something that's, physical, that you can touch and feel, that's meaningful, expensive, and important to both tenants who are making, the number one decision tenants can really make is where their real estate is. And then ultimately for landlords, it's, typically their most prized asset, the biggest, part of their net worth. And so, it seemed like as an asset category, there was a lot of allure to being part of that.
Yeah. Now that you've brought it up, I'd love to pick your brain a little bit on the current real estate market. Let's call it that. Especially because you're an expert, you're highly successful here in this area. What's your take on the real estate market today and how it looks over the next 6, 12, 18 months? And what's giving you a cause for concern in the area?
Yeah. So, I've been in the business, in the industry since 2013, and so that's a 10-year run. And I think for a 10-year run, things just went up and up and up and up. There's a hiccup with COVID and the scare, and then it went up and up and up as far as asset prices, activity, development. It just was almost a V-shape curve, in that things just got better and better and better over the course of 10 years. And, there's a lot of reasons in the economy for that. And today, a lot of the reasons that happened, they've changed. And the number one thing that's changed is the debt market, right? So, mortgage rates, interest rates, they're the highest they've been, is very long time. And so, and then construction prices are the highest they've been. And so when you have those two things at the peak, the numbers don't work. Meaning, for the numbers to work, you'd have to have rents come up enough for then your developer to create enough yield. And so, in simple terms, when you look at risk reward, you can invest your money and get a 5.5% return with the treasury and have 0% risk. So, when that wasn't the case, and your alternative investments, say, were to get 50 basis points of return or 1% return, of risk-free return, then everyone would flood into commercial real estate, because if you could maybe get a 6% cash on cash yield, well, that sounds great. Well, now a 6% cash on cash yield doesn't sound that great when 5.5% is free. So that's a lot of risk and a lot of illiquid activity to get a 6% return. And I think so where the market is today, as long as interest rates stay high, in the short term, in the next 6 to 12 months, activity will stay low because we're not adjusted to it. Meaning, are sellers willing to sell at a discount today? Because a buyer is going to say, well, I can underwrite this deal to an 8% return. Here's my offer. Well, now your offer is 20% lower because of the debt than what it was in 2021. And the reason those deals aren't getting done yet is sellers are not yet distressed enough. Typically, most aren't experiencing enough distress to say, yeah, take me out. I need out. But as, I think if we float 12 to 24 months from now, you'll see a lot of the, financing come mature, people that maybe built projects and had 5-year debt or pro formas, that, hey, we're going to refi in 2025. Well, now they're either going to have to show up with capital to the table at their refi with more equity or sell it. And so I think we're on the brink of seeing a lot of sales, more inventory coming to the market than there has been. I mean, you used to be able to sell an apartment building, multifamily building off market, have 30 offers in 2021 that all exceeded the seller's expectation. Well, we're not there today. And, it's quite hard to, no one's getting to the seller's expectations. So something has to give. Either say the debt markets collapse, okay, then buyers can flood back to low cap rates, or, inventory comes online, sellers experience distress, and then, buyers and sellers, the price matches. Right now, I'd say you're really at what you'd call a buyer-seller disconnect. I know you guys have talked a lot about that.
Yeah.
And that's just where we are. So if there's a buyer-seller disconnect, there's little activity, because sellers don't have to sell and buyers can't make the numbers work. And again, I think a lot of that's attributed to your alternative investment being, hey, I can go get 5.5% cash on cash return through the treasury for free. So the only way I'm buying this is to yield a higher return.
Sure.
Alex, we see with some of our peers and some of the sellers, they would like to sell, but because the inventory is down so far, they're going, what do I do with the money? Even if I sell, and what do I do with it? There's not enough inventory out there on the marketplace. And so it creates this gap, like you were talking about, that people aren't in it with enough pain to sell yet. But there is so much capital sitting on the side, just waiting. Mm-hmm. And we heard from some brokers in Florida that some of the people that were around buying big multifamily during the 7, 8, 9, 10, 11 financial crisis that were on the sidelines in the 2020s, 2021, the heyday while everything was going up, they sat in the sideline because prices were too high. Now they're coming into the market. They've got a lot of cash, and they're just waiting to scoop things up, and they are scooping some things up. But it was interesting in Florida. They were just saying the participants that they hadn't seen for 15 years are now back in the game. Some big people. What are you seeing?
I think that's right. I mean, to make deals work right now, cash is king, right? Not a lot of banks can lend, with minimum equity down. And so a lot of the patient family offices or institutional capital that look at things through cycles on a 5 to 10 year basis, they're now saying, hey, we can now bid on something that's not going to have 50 offers on it. Right. So, if to make the numbers work, if you're going to have to put 35%, 40% down, and there's certain groups that can do that to make the numbers work, they're back in the game. But locally here, I'd still say, sellers' expectations haven't changed enough where we're still at a disconnect, right? They're still, they still want, a 5 cap or a 5.5 cap. And with where debt is, it's awfully tough to make the numbers work there. Unless you had a need, unless you had a 1031 need, or you had incredible scale, you own the property down the street, or you own the property, or you have some goal to meet. But I think a lot of buyers are also still on the sidelines anticipating more stress, because you don't want to be the person that buys, at a 5 cap today, if you think it's going to be a 6 cap in 2 years. Mm-hmm. And then I think a lot of people that bought at these awfully low cap rates in 2019, 2021, so depending on where they bought it, you're anticipating a lot of rental growth in your pro forma, and you're also probably anticipating a refi at some point. And so when you take off that refi off the table, or if rental growth, in Omaha, I think it's between 4.7 to 5.5% from year over year. Nationally, CoStar said it was less than 1% year over year, which was the first time since the great financial crisis. So you're seeing, rents aren't just going to bump 11% a year like people, if you bought a property in 2019 or 2021, you saw, oh my gosh, we bumped rents 10%, 12%. It's not that easy every year. And I think the main thesis around real estate that a lot of people forgot is that, real estate's not a get rich fast game typically. It's a patient, long-term game. It's, very hard to hold an asset 2 years and generate a 40% return. We got in a frenzy of a market where cap rates became so low, money was so cheap, you could flip property, sell them, make quick money because rents increased, cap rates dropped. But usually, for most, the thesis is, hey, we're going to pay down some debt service over time. We're going to slowly raise rents, and then we're going to create wealth over the long term, not necessarily a 2 to 5 year hold.
Alex, what are you seeing in the Omaha area as I drive down 204th, Dodge Street, 370? I see a lot of construction going on.
Yeah.
And it would, on the surface, look like the supply, there's a lot of supply coming on. How is that affecting people in the multifamily market today with investings, with buyers and sellers?
Yeah, so the 204th corridor has been one of the hottest corridors in Omaha, and then Gretna, is just booming, and Omaha should be pretty proud. We've made significant strides in the last 10 years, 5 years, 3 years, as far as development, becoming more pro-development, a lot of great projects going on, attracting solid retailers, creating, which when you attract solid retail, apartments go on, be built around that. And so I think companies in Omaha have been growing. So that, Omaha's been healthy in that regard. But, we're starting to get a point where when too much supply comes online at once, it gives the tenant choices. So, it's always, does the landlord have leverage or does the tenant have leverage? The landlord's had a lot of leverage, meaning when your asset's 100% full, you can ask for 10% rental bumps or whatever it might be. But when there's 600 units being built across the street, then it becomes, when supply, anything with supply and demand, when supply increases too much beyond the threshold, it becomes a little cautious for everyone. So what you're seeing now in, multifamily, for the first time in a long time, people are renewing year over year, same rate. Some new developments are offering 1 month free rent on a 12 or 13 month lease just to get the property stabilized. That wasn't happening 2 years ago, right? So, and with that makes anyone's perform on a new development probably far different than when developments take 30 months. So 30 months ago, the debt markets were a lot different. Year over year rental increases were a lot different. And so, basically it means, here we are. And if you have a new development, things may not be going to plan as what you thought, because you probably performed, well, we're going to stabilize this without giving any concessions. We're going to bump rental rates 7% a year. Oh, possibly didn't know we're only going to bump it 3%. Oh, we're going to, place long-term financing debt at 3.5%, not 6 to 7%, probably closer to 7 today. So your numbers all of a sudden become, that affects your yield. And so again, when I go to that's why I anticipate over the next 12 to 18 months, there'll be some projects that, people want to sell because their pro formas aren't working out to what they thought they would be.
So how do you see this all playing out? I mean, based on the couple of things you said, I guess I could see, if the Treasury's giving 5.5%, buyers can just sit and wait because, that's a suitable option until they can find a good deal to buy. So how does that all play out? Does the seller just wait until either they become squeezed too tightly, or until something changes in the debt markets? I mean, how do you see this thing playing out?
Yeah, I mean, if I had a crystal ball, we'd all be on an island somewhere.
Yeah, right.
because that'd be pretty great. So I think no one really knows, the answer, right? No one knows,
Sure.
How does this play out? From the knowledge, we have, it seems like in 2025, probably late 2025, interest rates will decrease. But a year ago, we thought that would be probably by end of, 23, beginning of 24, and now it's already pushed further out. So, we're anticipating, if it does take till the end of 25, I think there will be a lot of newer developments that will be stressed because of the financing scenario, placing stabilized debt on something. So I think, at the rate they perform at, and, raising rents the way they thought they would, and, possibly having to show up to the table, for the projects that are on balloon payments, showing up to the table with more equity. People don't like capital calls. So that's when properties go to the market. And so I think you're going to see an influx of properties hit the market probably at the same time. That's my prediction, which will create some buying opportunities for those. Overall, today things are healthy. Land, for the most part, multifamilies properties are getting stable. Nothing is too concerning for, bless you, Steve. Nothing's too concerning for people yet, but you're starting to see some scenarios where there is stress. Mm-hmm. But yeah, I think, there's multiple ways to look at it. From a brokerage activity level, I think activity is going to be slow for a couple of years, slower, because, there's an election year coming up that creates political uncertainty. Anytime that happens, that actually affects brokerage business. Whether you're in office, industrial, people tend to wait to make decisions till there's more certainty in the political climate. So that's a headwind. There's interest rate uncertainty where, again, like we said, if you were building a project, you have to have certain rents to make those projects work. And if you don't have those rents, it doesn't work. So that affects, an office building today. I know we're talking mainly on multifamily, but it is interesting to know if you built a brand new Class A office building today in Omaha, Nebraska, you're at minimum $32 starting triple nets, probably closer to 35, 36, 37. Well, a lot of the projects in Omaha, the Union Bank building, the Carson Wealth building, and those properties are leasing for $24 net. So look at the difference. Those are new construction. And here we are at, you probably have to be almost a whole $10 a foot higher to make those projects work if you're building new. So ultimately that means less construction.
Yeah. Since you brought it up, let's talk about office space. Omaha, thankfully, hasn't been as affected as places like San Francisco, New York, places like that, where a lot of office space. But I'd love to hear your opinion on how long you think it'll be before we see a bounce back in office space, or if it'll even happen at all. I mean, do we imagine that we're going to get back to a certain level of office space being filled, or do you think it will remain that way until it's converted, it's demolished? I mean, what's your take on office space? Not necessarily in Omaha specifically, but you can speak to it if you want.
Yeah, absolutely. So I think there's two ways to answer it. There's nationally, and then there's in Omaha. Mm-hmm. Nationally, the trends are, work from home, and the workforce is demanding that. And you see, great PR around certain companies bringing people back to the office. But what you're also seeing is because of the unemployment rate, employees have a choice. And, I think long-term that dictates, where office space is heading. And also, I think there was a YPO statistic I was reading about. They interviewed, all the CEOs, and, the number of CEOs, and I'm, not quoting it correctly, but the number of CEOs say under 45 or 50 that, would be open to work from home, significantly greater, right, than if you're 50 years or older. And that's your future leaders of these companies, right? If you're that 25-year-old sitting in an office today who wants to work from home eventually is a CEO in 15 years, right? Yeah. And so I think the demographics do follow more work from home or flex work. And what that means, certainly I get it. It's better to build a culture. People are in the office, measure productivity. People are in the office. There's all the naysayers that say you have to be in the office. But I do think statistics and data are showing that there's just going to be more and more companies that utilize remote work and flex work. And flex means, certain departments are Monday, Wednesday, Friday. Some are Tuesday, Thursday. Some are just, in and out. So how you design your space might be differently. Omaha has been lucky in that there's been a number of large leases signed, especially with medical staffing companies, 100,000 square foot plus leases in the last year, that have, kept the office market really healthy as far as absorbing space. I think Omaha has, for Class A space, it's probably been the lowest vacancy in a long time. But I think what you see is Class B, if you think about call centers, right? Well, call centers, they'll never go back to the office. And when you actually think about the difference between A space and B space, A space means in Omaha, you're on Dodge Street, you're in a new building, you're investing in your space because you might want you want a bourbon bar in there, you want a coffee room, you want, a workout room, whatever. You're trying to gather your people. You're investing in the space because you want them in the office. Well, Class B office, while it's cheaper, if you don't care as much about your space, generally that means the leader probably doesn't care as much about being in their space, right? Generally speaking. So B vacancies have been really high lately. Even in Omaha, we've seen subleases hit the market. So, hasn't had a big effect in Omaha, but it has had an effect. And, in my opinion, I think there's kind of like politicians, a lot of brokers will say everyone's going to be back in the office, everyone, because they want to lease space.
Yeah.
And I'm not a politician. I'd say, work from home's here to stay. What that means to every company is something different. Does that mean normally if you needed 50,000 square feet, you now only need 40? Or does that mean you're programming your space differently? You're being more efficient? It means something different to every company. Say for the most part, client facing companies, Omaha is big on professional services, that your law firms, your accounting firms, your financial services companies, your medical staffing companies, they want prime real estate. And so that's what's kept Omaha really healthy. But I do think on a 10-year trajectory, office space nationally and even locally, you'll see more of the startups, more entrepreneurial companies try to maximize some element of work from home, because ultimately their rent, their real estate, besides human capital, is their number one expense.
Mm-hmm. So what happens to the excess space then if we don't go back to, pre-COVID times? I mean, does it sit vacant forever? Does it get converted? And have you ever seen anybody? Because the reason I ask this, I've read articles where people have tried converting an office space into multifamily or something like that. Have you seen anything like that? And how successful does that tend to work out?
I think that can be done in really dense urban cores. So when you think about New York City, when you have buildings on prime and prime, for Omaha, it's a little tough. If you had an office building off L Street or S Street, it's probably not going to be the perfect multifamily conversion, right? So I do think, the converting thing, it's a big thing in urban cores, New York City, Chicago. There'll be projects like that in time if they can buy them at low enough basis that they'll convert them to multifamily, convert them to hotels. But it used to be the question of what are we going to do with malls? Ultimately, malls did come back for the most part in a pretty big way. And then, even today you see, could it be converted to an Amazon distribution center? Could it be converted to pickleball courts? Could it be converted to just different things like that? It all comes down to location. Omaha office, again, I think, for the most part, unless it's downtown, you probably won't see any suburban conversions. Ultimately, you're hoping to find tenants. And for the most part, I'd say, I think Dodge Street office in Omaha's very safe office. I do think there'll always be companies that want to be along Dodge Street. Mm-hmm. And Omaha's in a really good position because our rents are lower. If you can rent space for $25 a foot along Dodge Street, companies want to be here because they don't want to be paying $60 a foot in San Francisco.
Sure.
So that's what Omaha has going for it. But what that also means is, depending on how businesses make decisions, there might be less new construction office in the future. Or if you're a developer, you might have to be a little more cautious. Or if you're even buying office, depending on your strategy, you probably, are going to be pretty cautious about what you're building and why. Omaha did have a number of spec office buildings, office that over the last 5 years got full. So it worked out well for the developers. But again, I think that's the difference between when we're talking about Class A new construction office. People want to be there. They want to headquarter their companies, make a real estate statement, being Class A office versus, hey, if some of these BC office buildings vacate, what happens to them? It's a good question.
Alex, you mentioned one thing. I can't pick up a magazine without somebody putting a pickleball in some old building. It's like everybody's wanting to do a pickleball. Give me your input on that. When I look at pickleball and everybody's putting this up, I'm wondering, how long is this fad really going to last? What are you seeing?
Well, it's
because you
certainly
have experience with pickleball.
Yeah, so,
I knew that was coming.
you're giving me a little PTSD here, Steve.
Yeah. Do tell the audience, please.
Yeah, come on. You got to be real.
The camera can't see, but I'm on week 9 of a Achilles rupture recovery, had surgery 2 months ago, playing pickleball. I'm beginners pickleball. And, they are saying that, I think orthopedics and those types of things have been quite busy because everyone's getting hurt playing pickleball. I didn't think I'd get hurt, and here I am. I haven't been able to drive for 9 weeks. So yeah, I have a little PTSD with it. But as far as the fad of pickleball, I mean, first of all, I think it's a great use of outdoor space when you're, doing a master development, when you're thinking about green space and how to create community, how to create, when you're thinking about mixed use developments with multifamily, office, retail, maybe, when there's outdoor events and you're trying to bring people to your development. I mean, pickleball fads here. It's the fastest growing sport. I think United States has probably seen since, football grew in the early 90s or basketball has grown globally. I think personally it's here to stay. And the reason is, everyone can play. I mean, when you think about sports from a philosophy perspective, well, if you're 50 years old, you're probably not playing basketball. You like to watch. And certainly if you go play, if you play your grandchildren, it's not going to be much of a match. You can't really play 2-on-2 with your grandkids. It's probably pretty tough, or 5-on-5.
Mm-hmm.
Pickleball has been, incredible because, it's, essentially, I mean, when you get to a competitive professional level, there's different dynamics, of course, for age and gender, but recreationally, I mean, it's kind of cool because everyone used to hide on their, phones and sit inside. And now you can drive to the park and you see grandpa playing with his son, daughter, and grandchildren. And the grandpa might be able to win. Right. So it's, it's really, the 18-year-old can beat the 70-year-old, or the 70-year-old could beat the 18-year-old, or the woman can beat the man, or however you look at it. So I think that's why it's wildly popular is, it really brings people together. And there hasn't been a sport that's easy to learn, easy to play, and, everyone can be pretty competitive at different age levels. So, they now have the professional league. I think and how that relates to monetization is when you think like how many people love football, but I love football. I never even played football. So it's like, wow, what's kind of the potential of this sport that everyone's playing, everyone likes, and they certainly can relate to because they play it. So it'll be an interesting story to watch how it grows professionally, with that. But I do think for real estate, master developments, parks, it's been, you can add something that brings people to the park instead of sit on their phone, or brings people to your development instead of sit on side. And then guess what they do after pickleball? It matters, right? They go to the your local coffee shop that's across the street. They buy coffee, and then or maybe they go to the office that's across the street and they go work. And so and then you have coworkers playing during lunch hour. So overall, I think it's a pretty positive thing, minus the injuries.
Are you planning to go back in and attack the courts again?
I am. I won't consider it a full recovery till I'm back out there.
Until you're beating the elderly.
Yeah.
That's
right.
Hey, watch that.
Oh, I wasn't saying you. I meant just in general. I think it's a great segue I've got one last question. Let's bring your crystal ball back out, Alex. Yeah. In times like this, whether it's COVID or whether it's what's going on with the Fed or whatever the case may be, you start to see asset classes start to perform better than others. One that might have been pretty good beforehand might now take the lead in being maybe an asset class that outperforms its history or its projections, whatever. When we come out of, let's say, end of 2023, do you see any asset classes that might be more advantageous for real estate investors, or more attractive that maybe wasn't beforehand?
Yeah, I mean, I would say generally speaking, the asset classes that have performed well over the last 10 years, and I'll just go through all of them. I think, that when things change, the more, safe classes remain. And that's where, when we talk about, I'll start with retail. Retail, everyone thought Amazon was going to kill retail. And now you've seen online storefronts want physical storefronts, including Amazon. And so retail's done incredibly well since COVID. Shopping centers are full, everyone's full. But when the economy shifts, and if we enter a recession, which usually is driven by, consumer confidence, consumer spending, GDP, retail usually takes the first hit, right? People spend less, and then retailers make less, and then the mom and pop struggle the most. And so, I'd say heading into a headwind, retail's performed so well. I think retail, will continue to have more headwinds into the future. If we enter a recession, or if we're in an extended recession, depending on how you define recession. Office, we talked about office today. Office has headwinds with work from home, and then new construction office becomes hard to pencil with where debt markets are, where rents are today. So I think you'll just see a little less office. I mean, construction as a whole will be down, but I think office has headwinds, right? More so than the rest. And then if you look at industrial's performed really well because of e-com, because of the need for distribution space in the growing economy. Of course, if GDP goes down, industrial might slow down, but again, probably remains pretty healthy. There's just such an undersupply of warehouse space, new spaces being built. So I think industrial has been a safe, good asset class. It's performed really well. That has less headwinds than retail and office. And then multifamily. When you look at the housing market, because everyone in single family is locked in their mortgages, right, at under 4%, they're not moving, which means there's no supply. There's no supply to buy a house. So what do those people do? They go rent, right? And that's why build-to-rent communities are growing really fast. It really is the solution for a lot of these housing problems. Hey, you can have something like a house, but rent it. It's how apartments, I think can continue to absorb until supply becomes too much. But multifamily, for all the demographic reasons, has performed really well. People will still need a place to live, and so I think multifamily continues to stay full. That the headwinds will be with supply. How much can rents increase in certain markets if we enter a recession, or if supply, if the guy across the street's giving away a month free, you bet that affects your property. So that'll be the issue. But I think as far as asset classes, I mean, there's a lot to like with multifamily. And you could have a thesis around all of them. But I think, when you look at major demographic shifts and how people work, well, that's a little scary for office. Yeah. Major demographic, shifts in the consumer can be scary for retail, though it's performed outstanding lately. And then, you're left with, more the stability and backbone of, America's housing. People need places to live. I think multifamily, remains good, projects remain safe. But, I do think, the difference in how we discuss value and debt affects, what the properties are worth. So when I said over the last 10 years, you could have been a fairly bad operator and made money, right? Because cap rates kept going down. So your property's full. Maybe you're not increasing rents enough. You're a little under, or you're increasing them as much as you want. But, you can make a lot of mistakes, still sell your property and make money because cap rates just went lower and lower and lower. when cap rates go up, you really have to perform as an asset manager. It's really how did you plan your financing? How did you plan your refis? How did you underwrite your pro forma, your rental increases, you controlling your expenses? So that's when it becomes the good operators separate from the bad, and some people get caught with their pants down, as they would say, and need to sell their property because they didn't have good underwriting.
Usually, Alex, you see that in the heyday when it was the Wild Wild West, all these people were buying multifamily, syndicating, and et cetera. And as we talk at Skyline Point Capital, when you're buying a piece of property, you're running a business. You're running a business. And when the cap rates started going up, it was interesting watching some of the syndicators. Now I've got to operate the property. It was more fun to buy. It was sexy to buy. It was fun.
Yeah.
All this type of stuff. And that's one thing we like about Skyline Point Capital. And what we're doing is in the sense that you've got to run the business. You've got to be efficient. You've got to see how you can provide and increase rents and then keep expenses down. And just like any normal business, you just have to run it that way.
Yep. I agree completely. And it really will separate, so many of the, syndicators that got in the game, they were buying property because it generates fee for them. Mm-hmm. But what the strategy generates fees, but what the strategy is, that's out the door because they just quote unquote run themselves. Well, that's not the case anymore, right? So
yeah.
And we're seeing it. Yep.
Yeah.
Yep. Well, Alex, I'd love to wrap up by doing a quick speed round. In the speed round, this is just for people to get to know you a little bit better. It's quick questions, quick answers. And if you're ready, I can just jump right in.
Let's go.
All right. What's one book that's most impacted you?
One book that's probably Daily Dad, Ryan Holiday.
Oh, that's a good one. He's a great author.
Mr. Stoic.
Yeah.
Yep. All right. What's one piece of real estate advice that you'd give to others?
Know your partners well.
It's a stellar answer as well. Yeah.
Yes.
All right. What's one thing in life, in business, or in real estate that you're really excited about?
Well, I'd say, number one is probably just, I've got a 2-year-old and 4-year-old. So, raising my family's number one. That's the best thing, that brightens my day every day. That beats any transaction I can ever do.
100%. You're killing this round. All right. All right. Last one. So the title of our podcast obviously is Heading West. And that's really, as we get to interview people like you, we start to see their journey as they quote unquote, head west in life and in business and in their faith, in their marriage, whatever the case may be. So as you head west in your life, in your business, where do you hope it ends up at the end of the road? And that could be a practical place. It could be, a place of feeling and emotion. It could be anything of the above. But where is Heading West taking you?
Well, I don't want to be a nursing bra and panty buyer again. So I would say, for me, short term, I want to learn to walk and drive, right? That's heading west. My injuries taught me patience. And then, long term, heading west, I think the more in real estate, brokerage is very transactional, so being able to work with people that have meaningful projects and, that I can always learn from. I think that's been my favorite thing about my career is I get to learn about people's businesses, their investment theses, their assets, and working with people that, are really passionate about real estate and their business. I just look forward to all the people that I will meet. It's really, it's all about connections and relationships and brokerage. And I think that's, when I look back on my last 10 years, the amount of friends, the amount of growth I've had because of people I've met, that's what my business is built on. And that's what I enjoy. And so what I'm excited about is all the people that I haven't met yet that I will meet and what I'll learn from them.
That's brilliant. Well, Alex, if people want to get a hold of you, if they want to keep track of you, where can they look you up? Where can they find you?
Yeah, so OMNE Partners website, or my email is aepstein@omnipartners.com. That's the easiest way to get a hold of me.
Love it. And if you guys are interested in learning about real estate investing, you can go to skylinepointcapital.com at any time. Ebooks, podcasts, all of it's there. But Alex, thank you again for joining us. That was a blast, and we're excited for the next conversation.
Hey, thank you guys for having me. It's really impressive what you guys have built at Skyline Point, and fortunate to know you both and have worked with you both in the real estate and personal capacities.